Welcome to the fifth webcast on the recently published discussion paper, Financial Instruments with Characteristics of Equity, or FICE for short. My name is Kumar Dasgupta, Technical Director at the IASB. Today, as before, I'm joined by Choi, Technical Manager at the IASB. Before we begin, a few housekeeping points. You can download the slides by clicking on the link below the slides window. This webcast is a recording, so we are unable to take any questions from the audience today. And last but not the least, the views expressed are those of the presenters, not necessarily those of the board or the IFRS Foundation. For those of you who have been following the webcasts, you will know this is the fifth in the series covering the FICE Discussion Paper. In the previous webcasts, we covered the board's preferred approach to classification of financial instruments. In this webcast, we will discuss the board's preferred approach to presentation of equity instruments. We will discuss how companies issuing more than one type of equity instrument should provide information about how returns are distributed among those equity instruments. In particular, we will focus on attributing total comprehensive income to derivative equity instruments. In the next webcast, we will cover the presentation of financial liabilities. Let us say you are an equity investor. On 1 January 20X0, you purchased ordinary shares of Company A. You own 100 shares, which represents 0.1% of Company A. The company has no other equity instruments. Come December, Company A makes a profit of currency units 10,000 for the year. Company A provides in its financial statements the earnings per share of currency units 0.10. From this, you will easily be able to work out that your share of profit for the year is currency units 10. In January the following year, assume the company issues a share warrant to another investor. The warrant allows the investor to buy 20,000 ordinary shares at currency units 1.70 each. And for the year, Company A makes a profit of currency units 15,000. The question now is, how much of the profit belongs to you? At the end of year 20X1, Company A not only has ordinary shareholders, but it also has the warrant holder, who is a potential ordinary shareholder. Out of currency units 15,000, how much do you get as an ordinary shareholder? What information would you get from the financial statements of Company A today? Assuming Company A provides EPS information in its financial statements, you would get earnings per share and diluted earnings per share information. Earnings per share is CU 0.15. The diluted earnings per share will provide a measure of the interest of each ordinary share in the performance of the entity, taking into account all dilutive potential ordinary shares. Assuming that the average market price of the share is CU 1.90, the diluted earnings per share is CU 0.147. What if the warrants were anti-dilutive? For example, if the exercise price of the warrant were higher than the average market price of ordinary shares. Applying IAS 33, the calculation of diluted earnings per share assumes the warrant is not exercised. No further information is provided about the warrant and how the warrant might affect the returns on ordinary shares. One of the consistent messages that the board has heard through a number of consultations is that investors think that there is not enough information about equity instruments. Currently, once a financial instrument is classified as an equity instrument, very little information is provided in the financial statements. IFRS standards have more comprehensive disclosure requirements for financial liabilities than for equity instruments. The absence of specific IFRS requirements to provide more detailed information about various equity instruments is one of the reasons why some equity investors and analysts support a narrow definition of equity. Under such a narrow definition, all financial instruments other than ordinary shares would be accounted for as liabilities. Consequently, entities would have provided more detailed information for all those financial instruments other than ordinary shares, as they would be subject to more comprehensive disclosure requirements. So the board has explored different ways to provide more information about equity instruments. In particular, how profit or loss and other comprehensive income of the entity is distributed amongst different classes of equity instruments. For non-derivative equity instruments, such as preference shares, the board's preferred approach is to present in the statement of financial performance the amount required to be adjusted for when calculating basic EPS as per IAS 33. For example, if an entity declared any dividends on preference shares, IAS 33 requires that the after-tax amount of those dividends is deducted from profit or loss when calculating earnings per share. The board's proposal is that those dividend amounts are presented on the face of the statements of financial performance. For derivative equity instruments, such as warrants, rights issues, share conversion options, the board's proposal is to provide further information about the distribution of returns among those instruments as well as how they affect the returns on ordinary shares. The board explored 4 different ways to show such information and reached no preliminary view at this stage. So the feedback regarding the benefits and costs of these approaches will be particularly valuable in deciding the way forward. This slide shows the summary of the 4 options the board considered. Option 1 attributes total comprehensive income to derivative equity instruments equal to change in its fair value. Option 2 uses the ratio of average fair value of derivative equity instruments and ordinary shares to apportion the entity's total comprehensive income for the period. It would involve dividing total comprehensive income between the derivatives and ordinary shares based on the average fair value of the warrant and ordinary shares during the reporting period. Option 3 allocates the entity's net assets, which represent the total carrying amount of equity, to the derivatives and ordinary shares based on the respective fair values at the reporting date. The carrying amount of each class of equity would be updated, and changes in their carrying amount would represent the total comprehensive income attributed to that class of equity. Also, there is option 4. The last option is to require entities to disclose the full fair value of all derivative equity instruments other than ordinary shares in the notes to the financial statements. Now, I'll hand over to Uni to look at each of these options in more detail.
Let's go back to our Company A example, where Company A has issued a share warrant as well as ordinary shares. Applying option 1, the full fair value approach, the carrying amount of the warrant will effectively be updated to reflect its fair value at the reporting date. This approach would provide similar information for all on-equity derivatives regardless of their classification, because it would provide information about changes in the fair value of the derivative for derivative classified as equity, as well as those classified as derivative financial assets or liabilities. This means that the information provided under option 1 would be similar to the so-called narrow equity approach, in which only ordinary shares would be classified as equity instruments. Under this approach, the fair value of the derivative would reflect the probability that the ordinary share will be issued as the derivative is exercised. In contrast, applying IAS 33, the calculation of diluted earnings per share or diluted EPS reflects only the intrinsic value of the warrant. IAS 33 effectively assumes that the warrant will be exercised immediately as long as they have a positive intrinsic value. Users of the financial statements could also use information about the fair value of derivative equity instrument for estimating the value of an entity's ordinary shares under this approach. For example, if you were able to estimate the value of total equity, and then you could deduct the fair value of derivative equity instruments to estimate the value of ordinary shares, assuming no other equity instruments. So assuming fair value of ordinary shares and the warrants are such that they are shown on the table above, the financial statements will look like the table below under option 1. The values in our example have been designed to make the comparison of the different approaches clearer, so it might not be the most realistic numbers, but hopefully it will help you compare the approaches. Assuming the fair values of the warrant has increased by currency unit 1000 during the period, the warrant gets currency unit 1000 as its share of total comprehensive income. The residual goes to ordinary shares. Assuming the opening book values of ordinary shares and the warrants are currency unit 146,000 and currency unit 9,000 respectively, the closing book values will be currency unit 160,000 and currency unit 10,000 as shown in the table at the bottom. The board thinks that the residual income attributed to ordinary shares could be used for the price to earnings type ratios, whereas the carrying amount at the reporting date could be used for the price to book type ratios. As you might have noticed already, it is possible for the fair value of the warrant to increase by more than Company A's total comprehensive income. Say, if the fair value of the warrant increased by 20,000 currency unit, which is more than Company A's total comprehensive income for the year 15,000 currency unit. 20,000 currency unit will be attributed to the warrant, and that leaves ordinary shareholders a negative amount of 5,000 currency unit. Some of you may find this counterintuitive, as Company A as a whole made a profit. In some circumstances such as this, the full fair value approach could distort the company's price to earnings or price to book ratios. Unlike this approach, option 2 is based on relative fair values. Applying the average or period approach, the entity would calculate the amount of total comprehensive income attributed to a derivative equity instrument in 2 steps. Step 1. Calculate the average of period fair value of the warrant and the ordinary shares, and then calculate the ratio of the average fair value of the warrant and ordinary shares. Step 2. Apply the ratio calculated in Step 1 to the total comprehensive income of the period. The rationale behind the average of period approach is to use the relative average fair value of the warrant and ordinary shares as the ratio to apportion the entity's total comprehensive income. The objective is to achieve an attribution amount that could be used by users of financial statements in a similar way as diluted earnings per share calculated by applying IAS 33. The amount attributed to derivative equity instruments and ordinary shares would be proportional to their fair value, and therefore, unlike the full fair value option number 1 we just looked at, it would not be possible to attribute a negative amount if the company as a whole made a positive total comprehensive income. And that's compared to diluted EPS of IAS 33. The average of period approach uses the fair value of the derivative equity instruments instead of their strike price, and is not limited to instruments that are dilutive at the reporting date. So, assuming fair values of ordinary shares and the warrants as they are shown on the table above, let's go through the steps. Step 1. Calculate the ratio of the average of the period fair value of the warrant and ordinary shares. Taking the average values from the table above, the average fair value of the warrant is 9,500 currency unit, and divide that by number by the sum of the average fair value of the warrant and that of ordinary shares. The resulting ratio is 9.5 to 190. Depending on how the price moves, a simple average of the opening and the closing fair value could be quite different from the average fair value during the period using more frequent data points. But obviously, there would be cost implication if you use more data points. For our illustration purposes, we assume the simple average between the opening and the closing fair value is representative of the average of period fair value. Step 2. Apply that ratio to Company A's total comprehensive income of 15,000 currency unit. The results are the warrant gets 714 currency unit and the ordinary shares the rest, 14,286 currency unit. Those amounts calculated on the previous slide will be shown on the face of statement of changes in equity in this way. The amount of total comprehensive income attributed to the warrant under this option is 700 currency unit instead of 1,000 under option 1. This is because the attribution is based on relative fair values, and therefore the attribution takes into account the increase in the fair value of ordinary shares as well as the fair value increase of the warrant. Because this approach focuses on attributing income earned during the period using average of period fair values, the board thinks that the resulting amounts attributed to different classes of equity would be useful for the earnings multiple type ratio. But for the same reason, this approach may not be the best for providing useful information about the reporting date carrying amounts. Now, the third option, that is end of period approach. The rationale of the end of period approach is to reallocate the amount of net asset, which is total carrying amount of equity, among the various derivative equity instruments and ordinary shares so as to reflect their relative fair values at the reporting date. Accordingly, the end of period approach might better depict the relative carrying amounts of different components of equity at the reporting date than would the other approaches. However, the end of period approach may not accurately depict the distribution of returns during the period because the changes in the carrying amounts of derivative equity instruments would include catch-up and other adjustments. The catch-up adjustment would arise in the period the derivative is issued because derivative equity instruments would be issued at fair value, whereas the carrying amount of net assets to be attributed is book value of equity, which would typically be different to the fair value of equity instruments. So assuming fair value of ordinary shares and the warrants as shown on the table above, let's go through the steps. Step 1. Calculate the ratio of the reporting date fair value of the warrant and ordinary shares, taking the values from the table above, that is 10 to 200. Step 2. Apply that ratio to Company A's net assets at the reporting date as given in the table, currency unit 170,000. Applying the ratio of 10 to 200, the carrying amount of the warrant at the reporting date is updated to 8,095 currency unit. Step 3. Compare the carrying amount of the warrant to the carrying amount of the warrant at the beginning of the reporting period. So that is comparing 8,095 currency unit that we just calculated to currency unit 9,000, the fair value at the beginning of the reporting period. And the changes in the carrying amount is a negative 905 currency unit. Therefore, a loss of 905 currency unit is attributed to the warrant, even if Company A made a total positive comprehensive income. And also in this case, a loss is attributed to the warrant, even if the fair value of the warrant itself has increased during the reporting period. This is the catch-up adjustment that is needed in the period the warrant is issued, as discussed in the previous slide. The catch-up adjustment occurs as the carrying amount of the warrant is effectively updated from its fair value at the date of issue to an attributed book value of equity. Those amounts calculated on the previous slide will be shown on the face of statement of changes in equity in this way. The board thinks that using this approach, users of financial statements could use the information for calculating book ratios of ordinary shares. For example, the price-to-book ratio for ordinary shares that is calculated using this approach represents the ratio of the price of the ordinary shares to the carrying value attributed to ordinary shares on a relative fair value basis. The board acknowledged that the approaches to attribute total comprehensive income to equity derivatives would involve cost and complexity. For that reason, the board considered whether disclosure can be used instead. In particular, the board considered disclosure requirements related to the fair value of financial assets and financial liability in IFRS 7 could be extended to derivative equity instruments, such as in the illustration shown on the slide. This information could help users of financial statements understand the distribution of returns among different equity instruments. By providing fair value information, it would also result in similar information being provided about derivatives on an equity, regardless of whether they are classified as financial assets, financial liabilities, or equity instruments. However, the disclosure would not show the full effect of derivative equity instruments on the distribution of returns among equity instruments, and disclosure-only approach may not be a sufficient response to calls from users of financial statements for better information about the effect on ordinary shares of other classes of equity. In addition to this disclosure, the discussion paper includes discussions about disclosure of potential dilution in Section 7. Those disclosures would apply when an entity has issued financial instruments that could require an issue of ordinary shares. The entity would need to provide the maximum possible number of ordinary shares that can be issued. This would apply to all potentially dilutive financial instruments and could provide some of the information requested by users of financial statements.
Thank you, Uni. On this slide, we provide a summary of how the financial statements would look under each of the options and compare that against what we have today. The slide also shows how price-to-earnings ratio would differ under each approach. In the board's preliminary review, a full fair value approach would provide information about the warrant that is the same regardless of how the warrant is classified. Also, the carrying amount of the warrant would represent the reporting date fair value, which is also useful information. On the other hand, a relative fair value approach, depending on the approach used for the calculation, would provide users of financial statements with better information to calculate price-to-book ratios and calculate earnings multiples, such as price to earnings. However, these approaches would also be costlier to implement because the fair value of ordinary shares would need to be determined as an input. Also, performing a calculation based on relative fair values would result in carrying values and amounts attributed that would not represent a specific measurement attribute of individual equity instruments in isolation. Our example assumes there is no other derivative equity instruments apart from the warrant, so the attribution shows the value transfer between the warrant and ordinary shares. But if the company had other derivative equity instruments, the attribution of income would show value transfers between different own equity derivatives as well as ordinary shares. The options the board considered includes disclosure, as we have just touched upon on the last slide. As we have said at the beginning, the board did not reach a preliminary view on which approach provides the best information considering the benefits and costs. The feedback received on this will particularly be valuable in deciding the way forward. In a few weeks' time, we will come back with the final scheduled webcast in the series, Presentation of Financial Liabilities. I hope you will join us for the last of this webcast, and I hope you have found the series useful. Last but not the least, thank you for listening.